The CEO Roundtable brings together operations professionals at the top of their game to define and explore what it means to be highly effective in a scale-up organization. And what sits at the heart of it is highly curated peer-to-peer roundtables where CEOs talk about things that matter.
I absolutely love my roundtable. We've been together for about 2 years, and without exaggeration, I have made friends for life.
To find out more, go to ceoroundtable.com. That's ceoroundtable.com. Hello, everyone, and welcome to another episode of The Operations Room, a podcast for COOs. I am Brandon Mensinger, joined by Bethany Ayers. How are you doing today?
I am shattered.
Shattered.
The honeymoon of being a CEO is over. I was ready for the weekend on Monday, and I don't know why I found the energy for the next 4 days.
Okay, so the bubble is burst. How many weeks are you in right now?
I'm saying 6, but I actually have no idea.
Yeah, it's all a blur.
I went from knowing the exact number of days that I'd been in to now just like most of my life. I don't remember a world before this.
Okay, so the honeymoon is over. So the reality of your situation, the reality of everyone's situation is now ever present as you head into next week.
Yes, but it's amazing going from not really understanding cybersecurity, not really understanding high level what's needed and the words being used. And luckily, the problem that we're solving is a problem that I can just understand, having been an operator, which is basically, in a nutshell, everything in our businesses is over-permissioned. And then you throw AI on top, and suddenly everybody can access the things that they have permissions to access, even though they shouldn't. And they never knew it because they can't find it on our horrible shared drives or buried in Confluence or Jira or whatever. And with AI, it all comes to the surface. So it's a very easy problem to understand as an operator. But like, what are the gaps? What are the most important things to build? What's the order of it all? It's all just become clear. All the dominoes just clicked into place. I see where we have to go and what we have to do.
That's amazing. I think in B2B verticalized markets like this, quite difficult sometimes to wrap your mind around things in short order, especially to come out the backside after 6 weeks and feel like you have a clear game plan of like what actually makes sense.
I feel like I understand the gaps. I feel like I understand the priorities and what absolutely has to get done. But we also need to move quickly and speak to customers, speak to prospects, test the market, show prototypes, and make sure that we're heading in the right direction. And we need to do it really quickly. So we're moving into basically weekly company sprints, where on the Monday, we say, what campaign are we running? What deals are we progressing? What features or technical support do we need? What are we learning? And then we go off and do that. And then on the Friday, top of funnel, pipe generated, deals advanced, deals won, deals lost. And what have we learned? And therefore, what are we going to do next week?
That's amazing. So the Monday morning, the Friday afternoon, sprint style, right across the entire company. The company is, again, 25 people, something like that. So that sounds like a real drumbeat cadence of focus.
It is. And I was like, I still need to speak to our engineering leaders after this to make sure that my idea works. Because I was originally thinking about it specifically with go-to-market, but then I was like, we're only 25 people and we're so interconnected between the product and the market that I think engineering need to be involved, hear the conversations, understand the learnings. And also, there's always this thing of you don't want to distract engineering with things that don't matter, but sometimes they're like, oh, I can do that. That's like 3 lines of code. And we need them to be able to be, oh, yeah, I can do that. And that's going to make your life so much easier. And then there's just like a lot of friction in the business that's been surfaced. Like our demo tenant has messy data and you have to do a lot to prepare before a demo. And I was like, we just need a demo that is amazing every single time. We can't have that sales has to worry about pre-prepping it and everybody needs their own. And so if somebody changes it, it doesn't mess up somebody else. And there's a good thing and a bad thing about the fact that we're coming into Q4 because we can do a huge amount of work to prepare for an awesome start to 2026. But we're in like the headwinds of everybody's natural energy level. We're coming from autumn into winter. People start to want to hibernate. Like our bodies are more tired. We have loads of energy in the summer. So I wish we were doing this in Q2, like physical body wise. Like we're going to have to work against our energy.
So you're right. There's a seasonality effect, isn't there? When you're sitting there in the spring, heading into the summer, there's a real zeal and energy and kind of more light and more like a capacity and energy, I suppose, to your point. And then come September, October, it feels like a grind.
And so I'm also thinking about how do I find my energy and then energize the team with the nights closing in?
Yeah. So how do you do that? It's interesting because as a personality type, as you know, I'm not a center of gravity when it comes to charisma. I'm trying to phrase it exactly. I kind of think about this sometimes coming to the office, like feeling energized, expressing that in some form. You know what I mean? Like giving some people a sense that Brandon's present and energized and focused on the job at hand. I struggle with the same thing.
For me, it's going to take a tremendous amount of energy and I'm going to have to find it from somewhere and then have my energy buoy the rest of the team. Like it's Friday. I wanted the week to finish on Monday. I don't know where that energy is going to come from, but I have to find it. Right now, it feels fairly impossible, but I'm sure in another couple days, like I do tend right now to just collapse over the weekend. Like I'm not seeing friends a lot. I'm just resting. And also I've been sick pretty much for 4 weeks.
Oh, that's right. You had a cold last week, didn't you? So you're better-ish.
Yeah, there's like a little bit going on, but enough to go back to the gym and exercise. But I am just trying to conserve some energy that way, doing some meditation. I'm back doing my writing class. And although it's hard to find the time for it, it's helpful to process my thoughts with the discipline of it. And in the writing class, it launched last week and it was interesting. We have 4 people in it who are working on product rather than doing any sort of exercises because they've graduated and they still come back and they work on the books they're writing and then they read excerpts and get feedback. And so Jules, our teacher, was asking them, what specific feedback do you want so that we're a helpful group for their writing? And I basically said to the group, I normally like constructive feedback. I normally like to learn and better my craft, but I'm not writing for you. I'm writing for me. And I'm in the class to just have some discipline to write. I just want you to tell me to keep going. I don't need any level of criticism or constructive feedback or how to do things better. I'm not in that space.
No mental capacity to process critique at this stage.
No, but it's also really freed my writing because I'm literally writing for myself and I'll just read a piece. I'm writing with no audience in mind, which is quite freeing.
Yeah, it's amazing. I remember when I was doing the acting stuff, we would always freak out before a show, highly stressful. The butterflies are right in your throat and you're like, all right, 50, 60 people is very intimidating. We're not very experienced. And our acting teacher at the time, he would take us through all these body movement exercises, breathing exercises to put us in like the right state of mind, the right frame of mind. And I've always kind of taken that since then more in the yoga realm, which is if I'm feeling out of sorts, stressed out, not feeling great, and I don't have a lot of time to re-energize myself or figure out how to, get back to a regulated state as you characterize it. The yoga sessions are always good for if you have a good yoga session physically and there's some level of like breathing exercises involved. It can do wonders within an hour or an hour and a half to reset you and clear your mind and feel better basically about yourself and your situation. So outside of the sprints, what else are you doing?
Yeah, so we're doing the sprints. We have the company's never had OKRs, so we're introducing OKRs, but it's very light touch because you know how I feel about them anyhow. But we have 3. I won't bore you with what they are because it doesn't matter. Although one of them is become an AI first company.
Oh, I love this one. AI first as an OKR. That is amazing. What are you doing on this front?
So we have 3 key results. One is every employee has, now I'm hesitating here because I pushed that every employee should have 5 AI employees. The leadership team, we had an offsite this week. This is part of the clarity, was spending a day together really hashing stuff out. The team had a bit of a freak out around 5. We agreed to 2, but when we launch on Monday, I'm going to go back up to 5 because we're now...
We've agreed. Now we're going to agree to disagree. We're up on the number.
Well, the reason why we're upping the number is also after the offsite, when we agreed the OKRs, we were going to do on our company offsite a very traditional, here's a 15-month plan, here are OKRs, work on our company values, let's do an escape room or, something escape room-esque. And then after the offsite, I realized we just have to move faster and people need to know things sooner. So I'm doing the OKRs on Monday, which means that we still have this offsite next week. And I'm bringing in Charlie
Cowan, the ex-guest that we had,
to train the team, and another guy who's going to be a guest on the podcast coming up called Ryan Fuller. I know, who
News
is
to me.
Yeah, he's an engineer turned CTO turned CEO who had a very successful exit to Microsoft and then stayed in Microsoft for quite a few years. And so I'm going to have him train the engineers, because I talked to him and he spent at least 15 minutes explaining to me why he doesn't know anything and he can't teach our engineers anything. And I was like, yeah, you're the person the engineers will want to listen to because you're not telling them anything. He's just like, I can just talk about what I've done. And I was like, that's all I'm looking for, just to open up minds and really understand new techniques and technologies out there. And so I figure if we're going to do 2 days offsite, which is AI training and team building, everybody can build their first 5 AI employees on those 2 days, or build 3 and understand what the next 2 are going to come. So I don't think 2 is a stretch, and OKR should be a stretch. So we're going to go for 5. So that's our key result for becoming an AI first company. There's also 2 other, basically building out, I don't know what to call them, AI automations, smart automations. So there's something on the tech side where you can use linear with something, I can't remember if it's GitHub or Claude Code or something, but basically linear and a coding thing can resolve and fix your bugs for you. And so we're going to experiment with that to just get rid of a lot of the bug fixing automated and see if it works. And then on the go-to-market side, do the 24/7 SDR who's constantly scanning the market for people in market, scoring them, writing the emails, sending them out, sticking them in a cadence. We've actually already built that. So again, we might need to up the key result. We've bought Git Cargo. Our RevOps guy absolutely loves it and is just building things overnight. Like, it's really easy to use. I obviously have not used it, but the feedback is it's amazing. So if anybody wants to have a little look there. Yeah, I think it's actually called Cargo, but the website is getcargo.app maybe. And so internally we're calling it Git Cargo. But when I go on the website, it just says Cargo. So I don't know. It's one of those where they couldn't get the URL clearly. And now it's whether or not their name is Get Cargo or Cargo. Anyhow, going back, so we have 3 OKRs. One is being an AI first company. Those are the key results. And then we don't have any set values in the company. It's just never happened. And so part of what we were going to do is we talked to Cameron Harold about it, the mission to Mars, who are the people who are most have the values, blah, blah, blah. And I spoke to the leadership team and I said, should we do that? Or should I just choose some values that I think will get us through this? And it was interesting. The team just said, yeah, everybody just wants direction. They just want to know what to do and where we're going. Just choose the values. And I was like, cool, I can do that. So then thinking it through, not sleeping a lot, woke up at 4 a.m, I think Wednesday night or Wednesday morning, whatever. And I was like, I know our value. We have one value. We can do hard things. That's it.
Simple, very clear. Where does that come from?
When I shared it with my husband, he's like, oh, but that book, I hate that book. And I was like, you don't read Glennon Doyle. What are you talking about? And he was talking about the Andrew Horowitz, The Hard Thing About Hard Things. But that wasn't where I came from for me. So Glennon Doyle, who wrote the book Untamed, has a podcast called We Can Do Hard Things. And that comes from when she was a primary school teacher. And it was a slogan in her room.
Yeah, for all the young kiddies. I love that.
I just think it probably encapsulates my being. I'm not afraid to have hard conversations. I'm not afraid of being uncomfortable. I'm not afraid of big challenges.
Yeah, it's such a great way to sum it up. We can do hard things. In particular, given your stage of company, what you're up against, that feels like the singular thing to lead on and to reflect on as you work through the next 3-6 months, because you have a lot of hard things to do for that company to make it work.
We know what we need to build. great ideas, and we just need to ship as quickly as possible, get it out there, get it tested.
On a lighter note, I went to the CEO Roundtable dinner last night at the Zettler. It was amazingly close to my office. Literally, it was across the street, about 2 minutes walk. It's one of those places where I walked by it 1,000 times going for lunch. Never took a second glance. Went in there, and this place is awesome. Like a totally vintage 1930s, 1940s style. And all I could think to myself was like, why do we go to this shitty pub around the corner for drinks after work on Friday sometimes? Why do we not come to this very stylish 1930s-esque vintage place to have a drink? That seems like such a better place to go.
Is it twice the price?
Yeah, probably that's the answer. So the roundtable was fun. So we had to, as usual, introduce ourselves, but she added a plot twist to the introduction, which is we had to talk about a story from each of us around what creates a good life and the lesson behind it.
Oh my God.
So I didn't realize this until I got there looking at the cue card in front of me. So instantly you're like, oh, fuck. It's like, what am I going to say? What is my story? And then she cut it into two halves, 14 people. The first 7 went, right? So all the stories, for the most part, I might be slightly over exaggerating, but they were all like deadly serious, very serious consequences of family situations, this, that, and the other. And there's nothing wrong with that. And, they can be quite meaningful stories, but having 7 of them back to back, like, I'm like, oh my God, I feel terrible about these people. So I went into this story around having fun experiences in the workplace. I gave this quick story. We had our Christmas party. This is back in 2014, 15, roughly 100 people having dinner. At that point, later in the evening, everyone was asking, like, where are we going for the kind of like after drinks, right? I live 2 blocks away. I have a 2-bedroom flat. So, this handful of people at my table, I'm like, yeah, we should go to my place. That'd be amazing. So next thing I know, the word gets out across the entire rest of the company. We all go to my flat. It's 3 floors up. Everyone traipses up the stairs. I'm leading the pack, get to the top. And in my head, I'm like, oh shit, my roommate. I walk in, knock on her door. I'm like, hey, is it cool if I have a couple friends over? And she's like, oh, okay, yeah, that's fine. Everyone's in, floods the flat. I'm not even joking. 2-bedroom flat, 80 people. We had maybe, I want to say roughly half inside the actual flat itself. There's a rooftop with a ladder on the backside of my flat. So not particularly well bolted in. All these drunk people like climbing up to the rooftop, which probably wasn't the safest thing to do. And then I could see once there was like, I don't know, let's say 40 people up there, I could see the roof flexing, right? Because it's one of these older buildings. And I was just like, holy shit.
They all come pouring through your roommate's ceiling.
Half of Swiftgate can be wiped out in one fell swoop because of my actions in this case. Later on in the evening, the chief marketing officer, it's always the marketing person. My roommate had a beautiful African horn. He grabs the horn, blows on it, and because it's an African horn, it's pretty fucking loud, wakes her up, my roommate. It's her horn. She freaks out, comes out. So at that point, the party's over. Everyone leaves. Fast forward 10 years, we had our SwiftKey reunion, and John and Ben, the founders of the company, when they were giving their talk around the highlights of their SwiftKey experience, they brought this up as one of their highlights, saying what an amazing party it was. And I was like, yes, fun experience. People remember. It was awesome, despite, obviously pissing off my roommate. And, it's like once in a while, you need to cut loose and have a good time with people. And fun is important as part of company experiences.
It is. And the problem is, you can't schedule fun and you can't mandate fun. It just happens. And it's the special moments.
Completely unpredictable. Yeah, that definitely was not planned. I'll tell you that much.
Yeah, it's always the best things because when you plan it, expectations are high, you force it, and it's just almost like de facto isn't fun.
Exactly. It's the manufactured force fun that we all do in companies.
Yeah, the escape rooms versus the just like random party at somebody's house around the corner.
We are revving up the engine of the podcast and looking for a great brand to sponsor the show. We have over 7,000 listeners now across COOs, CEOs, founders, and operational professionals who are decision makers for all kinds of technology, including HR, planning, strategy, legal, and other tools.
It's Beth here. I just wanted to thank you for listening to the podcast, and we'd love to keep it going, but we're going to need to get some sponsors in order to do that. So if you work at a company that could benefit from speaking to listeners like you, or know of a company that might benefit, please send them our way.
To find out more, go to operationsroom.co/sponsorship. That is operationsroom.co/sponsorship. So we've got a great topic for today, which is the economics of VC funds. We have an amazing guest for this, which is Edward Barrow. He's the co-founder and CEO of Cloud Capital and the former Notion Capital resident expert on financial strategy, M&A, and market mapping. That is a mouthful. So before we get to Ed, just wanted to ask you 3 questions on the economics of VC funds. So he said that there are 3 important questions that a CEO should ask of existing investors. The 3 questions are, when did they raise the fund? Meaning that if the fund is in its latter stages when they have invested, it means that they need to get a return on capital fairly soon, which means they're putting pressure on their portfolio to return cash sooner than later effectively. So that question of when did they raise the fund? Where do you sit in that time frame? That's an important question to ask to understand that. The second one was, what is the size of the fund? So the fund's a £100 million fund, and you're in a position where ultimately you can deliver a 300 million exit for the company, which is possible. That is a fabulous return for a £100 million fund. If it is a $3 billion fund from SoftBank, your chump change and your importance to that company may be a lot less in that case. So the size of the fund is useful. And then the third one, which I never really thought about, is where do we rank in the fund's performance? Your ranking, which they do, really means how much time and attention are they going to pay to you as a potential bet that's going to pay off. And again, going back to that notion of if you're later in the fund cycle and they're looking for liquidity, and maybe you're not a top performer, but there's a realistic path to exit, there might be additional pressure put on you as a mid-tier performer to basically get the company sold or get some kind of liquidity event. So with those 3 questions for the CEO, what do you make of that? And what's your experience, I guess, in those kinds of questions and I guess your investigations that you've done?
I'm trying to think of like what an interesting answer is other than it's very wise and he explains it very well.
Yeah, it's a pretty clear 3-question set, I think, isn't it? So Ed talked about secondaries becoming super common these days. What should CEOs know about this secondary situation? Because I think there's a couple red flags in my head around this in terms of your reality as a CEO and why this matters.
That you can actually exercise your options as they vest, rather than you can vest them but have to exercise in some other moment. So basically, if there is a secondary, you can cash in some of the shares that you've earned, turn the options that have vested, exercise them, sell them in secondaries, and take some cash.
Exactly, because I think this idea that if there's not a lot of M&As, ability for VCs to get a return of capital based on exits that are actually happening, and that's dried up to a certain extent, the way they're actually getting liquidity is kind of like the secondary kind of side of things. So if you're an existing investor and you need to get capital, participating in a secondary sale to the new lead investor that's coming in is part of that package. And I think the key question for a CEO is just making sure that you can actually participate in the secondary itself. And I've had 2 companies ago a very clear experience where, for whatever reason, I still cannot understand to this day, in the articles of association and the resolutions, in what I don't quite know, the employee base with vested shares was unable to participate in the secondary sale itself. And they were caught out with that, and they were surprised by that. That's not a good outcome. So I think this idea that very clearly joining an organization, can you participate in secondary sales, should they occur, is a very important question to ask, because if secondaries are becoming super common these days, it's such a clear, more short-term duration possible way to get cash in the bank that could be fairly substantial depending on the valuation jump of the company, instead of having to wait. I feel like in one of my investments right now, I'm going to be waiting for what feels like a decade to get a payback.
And it's also because there's a few ways for secondaries. Sometimes people come in and buy secondaries for pence on the pound or pennies on the dollar to get into companies, and of like their current valuation, but it would still be an uplift for early investors based on what they invested. And they just buy some of the secondaries and they're not actually buying a majority stake in the business. But then you also have these deals where they get pushed as new investments. Look, blah, blah, blah came in and invested an insane amount of money, but they're not actually like VC investments. They're in effect buying 80 90% of the business for that investment. And they are now really the owners, but it's not a total transaction. And so if you can't sell your secondaries in that, you might never really see an exit.
And you know what's fascinating? So literally as of this week, this was kind of a big deal to me. Signal AI, my former company, basically completed a fundraising round with Battery Ventures. It was characterized not as a Series E, which is a venture round, but characterized as an equity round effectively. So they're repositioning from venture over to private equity effectively. And the investment was 165 million US going into the company with a majority stake, basically, which means that they now effectively own the company, and they're now prepping it, I think, for kind of a P to P swap at some later stage. Being a P kind of play now, it's probably another 5 years before there's going to be like an actual proper P to P sale at this point. I think what ended up happening, and I don't know this, but with that majority investment, to your point, I think what they've done is probably cleared out some of the existing investors by purchasing their allocations with some of that 165 million US. And unfortunately, for people like me, they haven't gone into the individuals, as it were, that hold shares in the company, angel investors and so on. I suspect they've actually just gone after some of the blocks allocated to some of the earlier investors that had more substantial blocks, but not other folks like myself. So to your point, at least in this kind of, secondary situation, sometimes unclear what they're going to do, but at least in this case, I'm not getting my payoff, at least for another 5 years. Very frustrating. I'm sure all our listeners are crying for me right now. Last question I wanted to ask you was just simply the acceleration of vesting and how important this is, because if the lead investor in your company is looking for a return in, let's say, 2 years, and you've got a 4-year option grant cycle, and you're not aware of this, then that can be problematic, because at the end of the day, you want your 4-year option grant presumably to vest fully. And if they're wanting to have the business exit within 2 years, as an example, then you might get jacked just in terms of like not getting your 4, but potentially getting half of that.
Well, so I actually have an answer for this one, or a new piece of information I learned recently is the UK are an anomaly when it comes to acceleration as an offer. In the US, it is pretty much considered bad practice and is almost never offered. And you have to negotiate hard to get acceleration. In the UK, something like 85% of companies used to offer acceleration, but with maybe US influence, it's dropped down to 60 something and it's trending down. And in Europe, it's only 30% of companies or option plans that offer acceleration. So actually, now is the time to negotiate it, because it's going to come off the plate in the UK, and it already pretty much is off in the US unless you push really hard. And as an exec, like COOs, CEOs, CROs are in a good position to negotiate individually for acceleration because they need to be motivated for the sale. But across standard packages, the acceleration is not the default in America at all. And in the UK, it's rapidly declining.
Why do you think that is? There's no skin off the back of the company or the acquirer, really, outside of a bit of dilution, I guess. But yeah.
Well, that's what it is. So who's going to pay for this acceleration? And it's the investors. And so now that the market's switched and why should we pay? People are lucky to have jobs. And then the other part is it makes you in some ways more expensive to buy for the acquirer because they have to invest to tie you in a way that it's easier to kind of flip the rest of your money into their shares in effect.
Yeah, that's fascinating. So just to give the audience a bit of a broader perspective. So the idea essentially is if the company exits before your options fully vest, that they accelerate, whereby the entire 4-year grant is fully vested as part of the acquisition itself or the exit event. And the whole purpose of that is to tell the employer or the senior executive, look, we need to create value in the business as fast as humanly possible. Getting to an exit point earlier than later is better for everyone. So you're incentivized to make that happen as quickly as we possibly can. And you don't have to sit there, Brandon, and wait for 4 years for you to fully vest to get your payout. Because at the end of the day, what I don't want, or the employee doesn't want, is to be sitting there and thinking to themselves, I don't want this company to exit in a year. I don't want them to exit in 2 years. I want to not bide my time, but just make sure, angle my way to ensure the company kind of doesn't exit until a little bit later, essentially. And as a company, I think you don't want that. What you want is people flat out value creating from day one as fast as they possibly can.
Yeah. So as an exec, negotiate it and look for it, because more and more are going to default not have it.
We will pause here and we will move on with Mr. Ed Barrow.
What should COOs know or think about before they join a business?
Well, I think it's actually really important to understand the cap table of any company that you're coming into, particularly in the COO position. You're going to have a fairly sizable responsibility around fundraising, around preparing the business to scale and ultimately to exit through any of those sort of different exit routes. And how the cap table is structured, how people get their money back eventually at the end of this journey is incredibly important. And then behind that, actually the different funds and the different motivations behind those. So I think a cap table, you can say, okay, 20% belongs to this VC and 20% belongs to this VC. But actually, there's a huge difference in the motivations and requirements of different investors based on when they invested, how much they invested, the rights that they got, but then also where they are in their fund life cycle. How large are they as a VC fund? How much have they raised? How much have they been able to return to their underlying investors? And where do you stack in the distribution of performance within that investment fund? So I think you start by needing to just understand who those investors are, but there's a good amount that is really valuable to know about their motivations in turn. If you can do that, then I think you can really start to understand how all the different parties align and what pressures you're going to face, over the next 3 to 5 years as the business scales and you raise more capital, you look for exits. Who's going to be enthusiastic for an exit at 50 million? Who's going to be enthusiastic for an exit at 500 million? And who's going to be enthusiastic for an exit at 5 billion? And obviously, as you're scaling a business, it's really valuable to know that.
Could you maybe just pull out, I think you just said it, but pull out the 3 or 4 questions that I should be asking the existing investors at some point, probably in subtle ways, I suspect, but to get to those answers that you just talked about, what are the key questions?
And also the why behind them.
So I think actually maybe step back. Venture capital, how it, if you think about kind of the basics of it, VCs are what you call capital allocators. So they raise money from underlying investors called LPs, limited partners. Those can be angels or institutional investors, pension funds, endowments. And they go and raise that money. And they, over the lifespan of a venture capital firm, they might raise multiple pots or funds. And, their job is to go and invest that money into companies and then return that capital and ideally significantly more to those underlying LPs on typically an expected 10-year lifespan. So what that looks like in practice is if a VC fund raised money from LPs, they might have raised $100 million, let's say, in 2020. They ultimately need to return, ideally, $300 to $500 million, so 3 to 5 times return by 2030. So they have a roughly 10-year cycle to invest capital, to allow those businesses to grow and support them on that journey, and then to return that capital. So it's valuable, first of all, to understand when they raised that money and when did they actually have their, what's they called, a first close. So when did they first close that LP capital? Because they will be at somewhere along that journey. So in the first, sort of 3 years, so in that scenario from 2020 to 2023, they would have been deploying that capital fairly quickly, prudently, ideally, but fairly quickly to invest that money. They will have reserved some of that investment capital for what's called follow-on investments. So, maybe half of the capital, 50 of that 100 million, would have been to deploy into initially into new investments and then some capital reserve to participate in subsequent investment rounds. But as they're getting into year 7, year 8, so that's in a few years' time, 2027, 2028, they're going to start to think, okay, how can I start to return some of this money to my LPs? And as I said, by 2030, they are meant to returning all that capital and more. Often, and as is frequently happening in Europe, you can have several extension years. So funds can continue to operate into year 11 and year 12 with the approval of LPs. But what this obviously means is if you've got 2 different funds invested in your business, one that was a 2020 vintage fund and one that was a 2017 vintage fund, they're going to have different timelines. By now, your 2017 fund, 2025, where we are now, that fund's going to be looking for returns already. Whereas the 2020 fund, is quite happy to continue to see growth and performance before they start to drive liquidity. So actually, any startup has, as I said, typically got multiple different investors. Often they have different fund vintage, the year that they raise the capital, and therefore just the timelines of when they're expecting to get capital back from you will be very different. And understanding and aligning that, I think, is very important.
And another thing to mention, I think, Ed, for people who don't understand, is the consequences of not having a successful return for the VC fund. Like, why do they care? What happens if they don't do it?
Ultimately, a VC fund makes their money in 2 ways. One is on management fees. So if you raise a $100 million fund, typically you're allowed to take about 2% of the value of the fund each year during the life cycle of the fund as management fees, your fees for operating that fund. So a $100 million fund roughly generates about $10 million in fees. Now, most VCs don't work for management fees. Most of them are looking for returns, and they make money, obviously, when you sell your startup, and if that performs well, they will make some money. The way that works is they typically make 20% upside from every investment once they've returned the original capital. So again, if we're talking about a $100 million fund, they make 20% once they've returned the first 100 billion. Often actually a little bit more. So they have to reach what's called a hurdle. So it might be 110 million, 115 million, and then they make their money. So first of all, they are looking to have successful performance because obviously they want to make money. No good VC is sat there simply making a living off the 2% management fees each year. They're looking to actually generate money for themselves and see that performance. And the longer they have to wait for that capital, obviously they are delaying gratification on that fund. I think the other point, which is really important, is obviously every VC or every successful VC is looking to raise their next fund. So a typical VC is raising a new investment fund every 3 years, sometimes faster, particularly during COVID. People were raising very, very quickly, but typically kind of 3-year life cycle. So, they will start to deploy investments from one fund in the first few years, but in order to raise their next fund, they really kind of need to return some money from the previous one. The ideal scenario for any VC is make a bunch of investments from fund one, see great performance out of that fund, generate, have some great exits and great liquidity, have a big pot of cash ready to return to their LPs, and then be able to turn around to those LPs and say, actually, rather than me give you this money, would you love to deploy this into our next fund? And they recycle that capital into their next fund. And obviously they're going to make more management fees and more performance fees off that fund. So actually their ability to be successful as a venture capital firm and their ability to raise more money is very much driven, not surprisingly, by exits and performance of previous funds. So there's obviously a timing to that. If you're looking at your VCs and understanding when is their next fundraise and when would they ideally be able to turn the great valuation you've got on paper into reality, that's also a very useful data point to understand so that you can see how their motivations align. Are they doing really well at raising this new fund, or are they struggling? Would it be great if they had some capital to recycle into that new fund or be able to demonstrate they can return capital so they can raise more money.
So if one of the companies in the portfolio goes past the 10-year mark, they just consider like a write-off? It's just like, whatever. If they return some cash non-lead, fine. If they don't, fine. Like, how do they view companies that seem to go on for some time?
Particularly in Europe, the first serious VC funds started to scale up sort of 2010, 2012. And so actually we're seeing a lot of funds, now sort of sat in the position in Europe looking to return capital who have blown past that 10-year life cycle, are in year 12, sometimes year 13. There's even years 14 and 15 out there, obviously. The motivations of the venture capital fund in that kind of 10-year plus environment really depends on the performance of the company. So if you are a star performer, if you're doing really, really well, then actually venture capital funds and the LPs underlying the fund are often quite motivated to roll the dice and to continue and see if there's further performance and further upside. So in that scenario, you can do what's called a continuity fund. So essentially you can carve out that investment from the fund and put it into a new separate pot, a new separate vehicle, and essentially allow that investment to continue on. So we're seeing that now a fair amount with top performing investments in a fund, the top 1 or 2 investments, where they might be now at serious scale with the potential of an IPO or a very large exit in a few years' time, and no one necessarily wants to get out just yet because of the potential upside from that. If you're not one of those star performers, and the VC world really does work on a power law, so VCs economics mean that they are highly motivated by an investment that can return the value of the fund. If you're outside of that, if you're not in that top cohort, if you're in the kind of second quartile or third quartile, then they're going to look for liquidity. They're going to say, okay, let's find some way to get money back. Obviously, one option is to encourage the company to look at exit opportunities. So you'll often have investors at a board meeting saying, let's think about our strategic options. When we're coming to a fundraise, let's explore other things than just raising another round of funding. Are there opportunities to sell the company? Are there opportunities to get what are called secondaries? The other option is that the VC fund themselves can work with secondary investors. So there are specialist investors who will come in and buy out an investor. So they can buy out a VC fund from a particular investment. They could buy out the VC fund from their entire portfolio. They can actually buy out just one underlying LP. So if there's one investor, one limited partner behind the VC fund that for whatever reason really needs all their money back, then someone can come in and kind of step into their shoes. So there are ways to exit that without actually directly kind of involving or requiring the company to do a lot of work. But they will definitely at that point be looking for exit routes for their stake at the very least.
So if we go back to the questions that either coming in as a COO or if you haven't asked the questions and now you're there, what are the ones to ask? So one is the timeline.
Definitely on the timeline. I think the other is actually what is the size of the fund that you invested from? Because that will help set some guidelines for what is expected. If it was a $100 million fund and they invested for 10% of the company, that 10% of the company needs to ideally be worth $100 million. So the company needs to be $1 billion exit for that to be achieved. If the fund were $500 million or $1 billion fund, and there's obviously a lot of large scale, particularly kind of multi-stage investors, that really changes just the absolute quantum that they would be looking to return.
If they had invested, let's say they are one of these massive funds, so $500 million, billion, $3 billion, and they put 20 million in, are they actually expecting their whole fund to be returned? I can't imagine they are.
They are expecting a very sizable return, even at that stage. I think it is important to understand specifically what pot you're being kind of funded out of, because a large $3 billion fund is actually typically kind of subdivided into different pots. But certainly if they are investing out of the flagship pot from your fund, they are going to be expecting very, very sizable returns. And their support for you and frankly their attention to you as a portfolio company will, in large part be determined by the likelihood that you're going to be able to deliver on that. Yeah, and we have got a lot of large scale funds that invested with big expectations of very, very sizable returns, because obviously a $3 billion fund doesn't need to return $3 billion. It needs to return $9 to $15 billion, right, in order to perform well. And so you can definitely start to think quite carefully about, what is the reality of you as a portfolio company actually delivering on those expectations.
I suppose if you're a smaller fund, those carries matter a lot to your point. But if it's a larger fund where it's $3 billion or something like that, your management fees are astronomical. So the balance of power between the carry influence versus the management fee influence, it seems to me that, to Bethany's question, in these massive billion-dollar funds, the carry side of it is obviously very, very important, but the management fees are so high at that point that I can imagine there is a bit of a trade-off in the mindset of the GPs.
I think that's definitely something to be concerned about. And I think it is valuable where possible to kind of raise capital from investors who are really motivated to see the outcome that you're looking for and that you think you can deliver. Because if you are raising from a large fund and say you've raised from a multi-billion-dollar, multi-stage fund, but they've only put $1 or $2 million in at an early stage into your business, you have to recognize that you are just not going to materially impact the economics in terms of that return. And maybe they are, as you said, more motivated by being able to invest money quickly, mark up those investments to a new great valuation, such that they can go and raise another bigger fund. And obviously there are two very different ways of looking at the performance of an investment fund. One is the potential returns and one is the actual returns. So there's a thing called TVPI, total value to paid in capital. But essentially that's what's the on paper valuation of all of the investments that have been made. And then there is DPI, which is the how much money have we actually returned. Now, as a VC fund, you invest your money. When those portfolio companies then raise their next investment round, hopefully, and obviously typically that's at a higher valuation. Once that higher valuation comes in, you can, as a VC fund, mark up your investments. You can say, actually, this company and this investment I made is worth a lot more. And typically it's off that potential value that you may well be raising your next fund as a VC.
So we have, as a COO, asking questions of existing investors. We've got our duration time. We have size of the fund. What are the other key questions and why?
Where do you rank in the performance of this fund? So when they are deploying capital, they're obviously deploying capital across multiple different companies. And to a degree, those companies are competing in that portfolio to deliver on the outcome that the VC is looking for. If you as a portfolio investment are viewed as one of the performers who are most likely to deliver the big return, then obviously you're going to get more attention and more support. But there are other motivations. Maybe you're a company in the portfolio that can see an exit sooner. That actually may be really beneficial, as we've spoken about, in terms of enabling them to support the next fundraise that they're doing. So once you understand what has already happened with this fund and all the portfolio companies, you might have a much better understanding of their motivations. Obviously, that can be an awkward conversation. You might have walked in to a company that maybe isn't the top performer, and you're maybe aware of that from the outside, but actually going and having that honest conversation may be something that you as a COO can have, that maybe the founders can struggle a little bit to have that conversation with some of their investors. But understanding the reality of where the investors are at in their life cycle, in the returns they've generated, and where you rank in that can be incredibly helpful for you to try and craft that path forwards. And obviously, if you're demonstrating your alignment, they're going to be very, very happy to.
And I think there's one more important question, and I'm always surprised at how few people understand the pref stack and what has to return before they see any money.
Yes, I think it's very easy to look at a company and say, oh, you've raised X amount of money, so you just need to give that back plus some percentage return and everyone's going to be happy. And it's very easy to look at a cap table and go, oh, investors own 40% of this company. Therefore, if we sell for X, they're going to get 40%. That is really not the case in 99% of the time. The reality is that venture capital investors, particularly institutional investors, very often get additional rights when they invest. Some of those are basic. They get information rights, which basically means they get to see the board pack or the periodic update that you send out. Others are consent rights. They get the approval, yes, no, on major things like fundraising or exits or even hiring and budgets and so on. But probably the most significant is liquidity rights or liquidity preference rights. So typically when a VC invests, say they invest $10 million, typically they have a liquidity right that says they will get back at least $10 million. So that's called a non-participating preference right. So that is, if they invested, let's say, 10 million for 10% of the company, if you're exiting for 100 million or more, they will get 10%. But actually, if you're exiting for less than 100 million, i.e. that means their stake is worth less than the 10 million they put in, they get at least 10 million back. So they'll get that first 10 million off the top, and then the rest will be distributed out. And so that kind of sets a minimum bar for them. And often and most common now is to have a 1x non-participating. So essentially whatever money they put in, they get to return that first, and they get that first as a minimum hurdle. That's very common, but there are all sorts of other structures. So some investors don't have a 1 times return. They might have a 1.5 or a 2 times. Or you get to see what's called participating preference. So it's I don't get a minimum of 10 million. I definitely get 10 million, and I get to participate pro rata in the rest. So that's almost like a double dip, where in essence, their initial investment acts a bit like debt. It sits on top of the cap table. It gets paid back to them first before anyone else gets to participate in the rest. And when you're thinking about planning for those strategic options and having those conversations, and certainly when you're then into negotiation on a deal, that can have a huge impact on who's really excited to see that exit now, and who of them would really prefer to roll the dice and go bigger.
And it also makes secondaries that much more valuable. Why don't we talk about vesting and what you should be looking at in terms of your own options and the types of schemes you should be looking at?
Well, I think, first of all, it's worth noting that most non-institutional investors don't have any of those liquidity rights. So if you've had any early stage angel investors, often they don't have any of those things, but certainly management, founders, and option holders, employees, don't have those liquidity preference rights. And then in terms of vesting, obviously understanding the timelines and expectations of your investors is really important to understand. Obviously, in a number of scenarios, there's what's called an acceleration clause on your option vesting. So that means that maybe you have a 4-year vesting cycle on your equity, but in the event of an exit or a change of control, actually that vesting schedule can get accelerated and you get the full equity. So it's definitely worth understanding if you're coming in with a 5-year vesting schedule, but the investors want to see money in 2 years' time, then maybe make sure that is either aligned in terms of the vesting schedule overall, or certainly that if they push for an exit sooner, that you're going to see that acceleration and see your return.
And then there's also, if your shares, hopefully they're time vesting, nobody has a cliff anymore, like the market has definitely moved to time, and they vest over time and you can exercise them, make sure that you can actually take part in any sort of secondary sale, because that's a way to take money off the table.
It is. I'm not sure of the statistic, but it's depressingly small percentages of employees actually exercise their share options, which is basically, as your vesting schedule progresses, some of your options are no longer essentially options. They are, in theory, yours if you purchase them. And hopefully, if your CFO has done a good job, the valuation of those options is kept as low as possible, and it's possible to purchase those at a reasonable price. What that basically means is then they switch from options into actual shares. And then absolutely when it comes to the next funding round, then there might be secondaries or people, new investors coming in and buying equity from existing investors. Then there's an opportunity as a actual shareholder to participate in those. So as an operator, one of the increasingly likely options for you to get money back is through those secondary transactions. Those themselves have exploded in the last few years. There's a lot more of these. Obviously, we see sort of headline secondary transactions from people like OpenAI and Revolut at very nice multiples, and actually that is providing liquidity and value for a lot of employees. But it's actually happening across the board. So definitely, if you've got options that are vested at a reasonable share price that you can afford to buy, it makes a lot of sense to do so. Unfortunately, a lot of employees either don't do that or don't exercise those when they leave. And if you don't exercise those and leave, then after typically a 90-day window, that equity returns to the company to give out to the next employee. So if you can, obviously there's an affordability to that, but if you can, I think and you believe in the upside of the business and the potential for secondaries or exits, then it's a really good investment to make.
So two-part question, just a bit of a tail end on the secondaries. Is there a special reason why it's exploded in popularity as an actual thing now, where secondaries is now happening across the board? The second question is, let's pretend I'm a CO just about to raise a Series B, and we're going to talk to investors. What are the questions I should be asking of these prospective VCs in terms of their funds and their fund economics that is useful for me to understand as part of trying to figure out which VCs are the more attractive ones to us?
So secondaries have exploded, I guess, in kind of two ways in the last few years. One way is there is more capital wanting to get into really hot AI startups than the AI startups actually want to raise. So if you're a shit hot AI company and you're going out to raise $100 million seed round, right, which is kind of average size for a seed round with some of these, I think, maybe you've determined that you only want 100 million, just 100 million, but there's 200 million on the table. Then and people clamoring to get in, then actually one option is, to actually sell secondaries. And so we've seen a big uptick in secondaries in some of these big, very hot AI startups where there's more money chasing the company than the company actually wants to raise. Outside of that, actually, in the normal world, the secondaries explosion has really actually been driven by two factors. One is the lack of exit opportunities. There has been, there was for quite some time a lull in the M&A markets, and as I think we've all seen, there has been until relatively recently a very, very quiet IPO market. So not much opportunity to exit in the traditional sense of the word. And at the same time, as we've spoken about, a lot of VC funds getting to the end of that 10-year life cycle, keen to get their money back, or maybe even earlier, as we said, if they're trying to raise their next fund. And so there's been a lot of capital kind of locked up in startups and locked up in these in growth stage companies in particular, where investors are keen to get their money back and maybe prepared to do a deal, to take a discount on the last share valuation. And so it's a great market if you're an investor who's prepared to buy existing equity from previous investors or employees or a combination of the two, and you see great upside in a particular company or portfolio of companies. It's been a great investment opportunity. So we've seen a large growth in secondary investors, specialist investors, or pots of money dedicated to this strategy in the last few years. And it's really because we are, again, particularly here in Europe, seeing a wave of VC funds get towards the end of that life cycle. Kind of the first proper generation of venture capital funds in Europe is now really at the end of that life cycle. And that has driven demand for secondaries on that side. And it's great if, as an employee, you can participate in that wave. To your second question, what should you do when talking to new investors? Actually, some of the questions are very similar. So if I have a conversation with a VC fund and they're making their sort of 5-minute pitch on who they are as a fund and why they're amazing and going to make you incredibly successful, a good question to ask is, what vintage is this fund? When did you raise this fund? How much did you raise? How much of that is being deployed into primary investments into new investments versus for follow-on investments. How much of that fund have you already deployed? How much is left to deploy? What is your typical investment size? So if you're making you've got $100 million fund, and you're deploying half of that into primary investments, and your typical check size is 5 million, then it's much clearer to understand how many investments there will be in the portfolio, how many of those they've already made, and how many they've got yet to make. Maybe they've actually only got a kind of couple of slots left in this fund that they want to deploy into. But if they're already 5 years into the fund, you have a pretty good idea that actually they're going to probably want some money back relatively soon. Typically, when you're raising capital, what they won't know is what's kind of the stat rank of companies already in that fund. They're often, as should be, they're in the first few years of deployment. So they're mostly focused on investing into those. They're not really sure who are going to be the runners and the riders just yet. But you can certainly understand that, if you've got funds already on your cap table that are already in year 5 and year 6, and you're bringing in a fund now that is right at the beginning of its life cycle and with a much bigger fund size, you're going to have different motivations.
So, Ed, final question is, if our listeners can only take one thing away from the conversation today, what is that? That
your cap table and your group of investors is not as simple as it may appear. And if you actually want to have a productive relationship with those investors and want to get to a great outcome that everyone is aligned on, then it's worth having those conversations now with your existing investors, understand where they are in their journey, and have perhaps some empathy for the VCs on your cap table and their job and what they're tasked with doing. So if you can understand what is driving them and motivating them, then you're going to have a much, much easier time as an operator.
Thank you, Ed Barrow, for joining us, and please subscribe or leave us a comment, and we will see you next week.